That was the closing bell on Wall Street, closing off the lows of the day, but still a very ugly day for stocks. Dow closing off just over 1,000 points. S&P off 3.5%. The NASDAQ was a big loser today, closing off just around 5%. All 30 of the Dow stocks in the red today. Biggest decliners, Salesforce, Nike, and Apple. Let's talk about what's going on here, what we could expect going forward. For that, we have Johan Grahn. He's Allianz Investment Management, Head of ETF Strategy, and Paul Kim, Simplify ETF's CEO. Johan, first to you. We're looking at a very ugly day, complete reversal from yesterday's strong gains following the Fed's announcement. What's going on?
Yeah, it's a bit of a head scratcher. I don't think anyone was expecting that overnight, perhaps. And I don't really think anyone has a straight answer for you today. I've been watching a lot of the news channels, right? And there are so many different opinions on this. But I would like to say that it could be that you have the initial reaction of the Fed yesterday being a bit less hawkish. I mean, frankly, they took away the 75 basis point idea and they replaced that with the idea of perhaps going 25 a little bit later and saying again that they will adjust as the markets continue and as the data comes in. Now, you might sit back and wonder, what kind of data can they actually expect to see in the next couple of months that will change the tune? I have to believe that there's not a lot of data that they can see that will actually make them change that tune. So it will be more of the same, and I think the market may have realized that today, and some of the trading is probably coming through.
So, Paul, when you see the difference between what we saw yesterday after the Fed announcement and what you're seeing today, how do you pass through this to figure out what are the clear signals to watch for in the market versus the noise?
Sure. So I think the big picture is that while one day the market had a reprieve and some of the dovish expectations came out through what Powell was saying, but really what the long-term consequences are is that inflation is very sticky and it's not going away, and one person's speech, no matter how powerful that person is not going to change it. The job market's very tight, as some of your recent participants have talked about. There's tons of geopolitical impacts, especially on things like energy and food, which creeps into everything else. Supply chains remain challenged, and we have now Chinese COVID shutdowns, which may make it even more stressed. Bottom line is there's too much demand for goods and services, not enough supply, and the Fed can't solve the real world problems. And I think that's sort of what's causing this indigestion.
Paul, do you think we have seen a bottom yet, or do you think maybe we could see further losses here in the coming days, coming weeks, coming months?
Well, I don't think we've hit the bottom yet, simply because I think we're just starting the hiking process, and there's arguably hundreds of basis points potentially to go. And so at least within the bond world, I think not all of that is priced in. There's still a debate about whether the Fed will continue to hike, plus just the fact of pulling out the liquidity in the market through a very high tax liquidity drain of close to $500 billion, QT about to start, which will ramp up to almost $100 billion a month in a few months, and then all sorts of deleveraging as asset prices fall. So we think volatility is here to stay for a while, and rates will continue to go higher.
So, Johan, in an environment like this, where are the safe havens to be found, if any?
Yeah, it's tough, and it's really hard for people that have less time on their hands, right? So if you think about people that are retiring or just in retirement, they can't really stay in the equity market, and the bond market hasn't really been kind to them. If you look at what's been going on right there, they might be down 10% already this year, and then you layer in inflation, which, sure, you can look at the prints and say that maybe it's 5, maybe it's 8, depending on how you think about this. But if you're a retired individual and you're looking at getting on a cruise ship or taking a vacation, or even buying a vehicle, that inflation number is going to take a much bigger bite out of your wallet, right? So to your question, like, what do you do? Well, if you're not happy with cash, then you might want to reconsider, fixed income as rates have come up. If you can't find enough in the fixed income market and you're still nervous about where the Fed might be going, and I would agree with Paul here, I think we're all seeing this going in a continuous rate hiking environment. We're going to see that for quite some time. Then it still leaves the equity market. Now, of course, it's even shakier, and the Fed has effectively put a bit of a cap on how far up it can go. And at the same time, they're taking away that safety net on the bottom of the equity market. So there are ways to trade it. You can either do it if you're a sophisticated investor. You can buy an options contract to give you a structured outcome that plays to the equity market. Or if you are not comfortable doing it on your own, you can buy those type of strategies in an ETF.
Paul, at the top of the last hour, we were talking to Jeffrey Kleintop. He's with Charles Schwab, and he was saying to look outside of the U.S. at a time like this. He mentioned the fact that international stocks, that they had a solid April. They outperformed U.S. stocks by about 8%. He was suggesting investors look elsewhere here for opportunity. Are you seeing any reason to buy international right now?
I think the flight to safety is still to the dollar and to the U.S. markets. And despite all of the volatility we're seeing today, EM and particularly developed in Europe and Japan may struggle even more. So I actually think there's two ways to play this that if I could talk about. One is to hedge out interest rates. We have a great strategy called PFIX. It's up nearly 60% year to date, and essentially it benefits when rates and rate volatility goes up, and it's been a great way for investors to hedge. And the other strategy that we may be appropriate for this type of environment is a brand new strategy called CTA. It's a managed futures strategy that can perform in high inflationary environments as well as markets going up or down. And both have been very great exposures in markets like today.
And Johan, when you look at things like the strength of the dollar, which a lot of people are saying, look, this is going to make it difficult for other countries to get their inflation under control, and that domino effect could come back to the US. With that in mind, how should people be positioning themselves?
Well, you have the same issue with choosing between different asset classes. So regardless of the dollar strength, and it kind of plays more into the actual overall economy and the dampening effect. You might say on a trade-weighted basis, the dollar impact for us here in the United States is not that big a deal, at least not yet. That obviously can change. But as it relates to the average consumer, if you will, or average investor, they don't necessarily think about the currency exchange trading opportunities that might be out there for other types of investors. So it really comes down to making sure that you have a buffer, if you will, in terms of how far or how much losses you're willing to take. And then at the same time, giving you an opportunity to participate in the upside in the equity market. It's still a solid trade for most people.
Paul, what do you think about the consumer right now? Because inflation clearly a huge concern amongst investors. How long consumers are going to be willing and able to pay up for some of these products? We're starting, of course, to see that hit certain companies. But overall speaking, I guess, how are you looking at the consumer right now and how that plays into this recovery?
Sure. With respect to U.S. consumers, they're in pretty good shape, all things considered. Cash balances are near record highs, and home equity is still, for now, a very strong dollar amount. And then you have lots of, again, wealth tied up. And so consumers are still feeling the benefits of the wealth effect of the sort of Fed policies in the past. However, you're now seeing sort of the optics of inflation, right? Paying $100 or $150 for a gas tank and the grocery bills, and then eventually for new homeowners, higher mortgage checks, on and on. Those things come out of a limited budget. And so as the inflationary pressures build and forced necessities take a bigger wallet share, you're going to find that some of the discretionary spend is going to struggle. And eventually going to hit, but for now, they're in a pretty decent shape.
All right, Paul Kim, Simplify ETF's CEO, and Johan Grahn, Allianz Investment Management Head of ETF Strategy. Thanks to you both.